The energy sector is again at the center of geopolitical uncertainty as tensions in the Middle East reach a fever pitch. Today, let's break down how the ongoing conflict between Israel and Iran is shifting global oil dynamics and compare it to past crises like the Gulf War and examine some recent market data that are shaping the outlook for oil and gas futures. The conflict between Israel and Iran has escalated dramatically, as most of you probably know, sparking fears of regional instability in one of the most pivotal corridors in the world. The conflict between Israel and Iran has escalated dramatically, sparking fears of regional instability in one of the most pivotal energy corridors in the world. The Strait of Hormuz, which facilitates the transit of nearly 20% of global oil, remains at risk, though we haven't seen major disruptions to exports so far. Oil prices climbed significantly as spikes as high as 13% in a single day. Yet the markets have proved more muted than in past crises, with prices hovering between $74 and $77 a barrel. Why? Largely because actual supply disruptions haven't materialized and OPEC Plus nations retained spare capacity to buffer potential losses. To put this in perspective, the Gulf War in 1991 saw catastrophic damages to Kuwaiti oil wells, with nearly 700 set ablaze as Iraqi forces retreated. This resulted in the loss of 4 to 5 million barrels per day at its peak. Oil prices initially spiked from $30 to $40 a barrel, but collapsed shortly thereafter because of reserve releases and ramped up production by other nations. Today's tensions, while severe, lack the widespread physical destruction seen back then. Amid these uncertainties, here's where prices currently stand. WTI crude for July contracts is priced at $72.34 per barrel, while Brent crude for August sits just above $74. Natural gas futures haven't seen as much volatility. They're holding steady around $3.58 per million British thermal units. Meanwhile, oil and gas rig counts tell another story in the U.S. The latest data shows U.S. rig count has fallen to 555, a significant drop compared to last year. Oil rigs declined sharply from 473 a month ago to 439. However, gas rigs appear to be an outlier, with a 13% increase during the same period, jumping from 100 to 113. This reflects a tactical shift in drilling strategies, likely influenced by market conditions and demand forecast. What does all this mean? First, the Middle East remains a critical focus for energy investors. Even the perceptions of risk can fuel volatility. Second, while today's crisis has parallels to historical events, markets are better positioned to absorb shocks thanks to strategic reserves and improved production capacity. Finally, the U.S. energy landscape continues to adapt with resilience at the forefront despite declining activity in oil rigs. Geopolitical tensions remind us of the delicate balance in energy markets and the role of robust strategy in times of uncertainty. What unfolds in the coming days could have a ripple effect across the global economy. Stay informed, stay adaptable. I'm Mark Roach. This is FutureWise Energy.